All right, good afternoon, Guaranteed Rate Affinity loan officers and to our referral partners out there. So great to have all of you join us today and really, talk about reverse mortgage for purchase, which I think a lot of people out there don't really realize that you can do a purchase with a reverse mortgage. And really what this does is it opens up a whole lot of really great borrowers, who may be in a situation, especially with the higher rates, not able to move, not able to understand how to tap into that equity that they've built up over decades in some cases, or they are in an area that has really appreciated well over the last several years. And we want to be able to show you many of our agent partners and referral partners out there don't know this. And this is a secret that really should not be a secret anymore, because it is a game changer to really help sort of stir the market up, to allow you to, go to your clients, your sphere of influence, and let them know that there's opportunities for them to still have a dream house. And almost the greatest thing is to have a dream house and not have a payment. So we're going to get into these basics. And we realize that this audience that we're going to be talking to may not know a whole lot about reverse mortgage, if anything at all. So we're going to get really granular, really foundational level understanding about the reverse proposition and how Guaranteed Rate Affinity and LoanBridge have really teamed up with one another to get trainings out, to be more active with our referral partners and our loan officers at Guaranteed Rate Affinity to provide more of this insight. So today we have a great presentation on deck. It's going to be about 25 minutes. Please feel free to ask questions. That's going to be a big part of you feeling more comfortable about this subject. So ask questions. We have a great group of people behind the scenes that can answer those for you. But if we don't get to your questions, we're going to be downloading them all, and we will make sure that we're getting back to you with those answers to the questions that you have. So that's the most important part. But with us today are some of the great leaders from LoanBridge Financial. We have Rob Cooper, who is right, at least for me, with the glasses in the middle of the screen. And we have Francis also from LoanBridge, who's really two gentlemen here that are really amazing at knowing the ins and outs of reverse. This is what they live every single day for years and years and years. So we have great folks on here to steer us through. So Rob and Francis, thank you guys for joining us, and really looking forward to the next 25 minutes. And Rob, with that being said, why don't we get this going?
Okay. Hello, everybody, and really appreciate this, Frank and Carissa and Joe. So I'll get to it. And this is something, folks, that I've given to hundreds of times to real estate agents across the country. And what I'm putting in front of you is literally the types of value propositions that I have come to find that agents want to hear and learn about. And Frank had mentioned it, that, a lot of people, and I would say that's our biggest hurdle, is people don't know about this program. And the question I always get, well, why is that, Rob? It's been around since 2009, by the way. It's FHA insured. The reason, in my opinion, why customers, why real estate agents, builders didn't know about it and don't know about it as an everyday core financing option for the baby boomers is because you didn't need our help. You did not need it. Let's face it, the last 12, 13 years has been a seller's environment. And there were so many homes being sold. To learn about something new, if I were in your position, probably be the same way. Times have changed. Now we're getting more eyes and ears on this program, and it's really, really important for you to understand this program. And I'm speaking at a macro level, talking about a national statistic. In 2022, I don't have 2023's numbers yet from NAR, but in 2022, 39% of all of the homes bought in 2022 were by the baby boomers, 62 years of age and older. I believe it was 60 years of age and older. So it is most likely, depending on where you're located throughout the country, most likely a significant part of your business, at least one out of every three, statistically speaking. So this is exactly what this financing option is focused on. What is it? Why does it allow you to continue to sell more homes in a market? You're going to be taught on how this will transact higher sales prices for those customers, i.e., it's going to be better commissions for everybody. It's going to allow the customers to purchase the home they want to buy, not the one they think they just can afford. It's going to open up the road for you to show more homes. You're going to generate business, and this is really important. And I've seen this working a lot over the last 4 or 5 months. It's going to generate business from customers that you've spoken to that did not transact. So they're either still fence sitting or they probably are sitting in your lead database and they're cold. I'm going to talk about that a little bit more. And it's going to help you increase your commissions. I think by the time we're through this 20 to 25 minute presentation, you're going to understand why. And as Frank said, if you have questions going through this, please, let's answer them. I'm a strong advocate of answering all questions we can. I will stay on as long as we need to, along with the rest of the team, and answer those questions for you. And the best way, in my opinion, to share this with everybody is to go over a real life case study. The names are different, but this case study actually happened in February of last year, okay? So you have a couple, they live in Northern California, they've been in their home 25 years, raised their kids, the stereotypical type of customer we're talking to, right? However, they've grown tired of the lifestyle, working and the work required to maintain their home. So in other words, the kids are gone, they still have a big property, they still have a big home, and they're getting tired of it, right? We hear, I'm sure you guys hear it all the time. They have to drive 25 minutes for the medical services that they're going to. They're 68 and 65-year-old married couple. They've looked at homes in Phoenix. Remember, they're in Northern California. Why did they look in Phoenix? They wanted a warmer climate, of course, consistently. They will get a warmer climate in the summer in Phoenix for sure. And they wanted to be closer to the grandchildren and children. That was the number one reason. And by the way, all of you on this phone, that is the number one reason that the baby boomers moved. The number one reason is they want to be closer to the kids and the grandkids. So they were looking at a condo or some kind of pub with low maintenance. Remember, they're just sick and tired of maintaining it. I'm not 68 years old yet. I'm tired of maintaining the home. So here's their situation. They refinanced. They had a mortgage. They refinanced their home, of course, with I'm sure this is something you're hearing all the time, to a 3% interest rate. Their current mortgage with taxes, the T&I, was $1,163 a month, and you can see the breakout. And they believed that they could sell their home for $650, and I told you they had a small mortgage. They owed $150,000. So if they sold today, they'd net approximately $455. That's with all of the selling costs involved. And they have about $750,000 invested. They did not want to touch, okay? Even though they're doing it now, they were doing it then to pay the living expenses. They were trying to drastically to figure out a way to move and not continue to have to draw on that. So they spoke to their real estate agent who got them over to their mortgage partner. And at the time, remember this was, I believe it was February of last year, they were looking at putting down a down payment. Remember, they believed they were going to get about $455 in proceeds. So they were going to put down $450. They were going to mortgage another $200, 6.5% interest rate. Okay, 1264. Sorry, guys. 1264 was going to be the cost. Then you throw in the taxes, insurance, HOA, because they moved into an HOA. So now they're looking at an $1,885 cost, which is that's per month, which is $722 increase in their fixed monthly obligations, right? Their debt service. So the higher monthly payment increased risk outweighed it. They're like, there's no way, we're worried to death about it. And they decided, hey, we can't do this. They were devastated. They can't do it. And they're just going to continue to draw on that 750. And they said, oh, we're just going to live with it. So, oh, this got mixed around. Not sure why, but it got mixed around. Sorry about that, guys. Frank, sorry, this got completely changed. Bear with me, folks. I'm sorry. Okay. Sorry about that, folks. I got the wrong presentation. I didn't finish it. Case study.
Rob, do you want to go back to maybe the one that you had prior to this?
Yeah, sorry about that, everybody.
No worries.
How come? Bear with me. Good. Here we go. It's almost there, folks.
The anticipation is.
I know. What I was doing this on purpose, everybody, to get everybody excited about it. Just kidding. Okay. So where were we? Here we go. So let me start sharing again. Okay, everybody can see?
Yeah, looks good.
Okay. So remember where we were, right? That was a $722 increase. So remember, sorry, I had to break the flow here. They sold their home. They were thinking they could sell their home for $650. They were looking at go ahead and be able to purchase a home for $650. Right? They had $455. They were going to put down $400, and then they were going to get a traditional mortgage on $200 at 6.5. Long story short, I'm being redundant on purpose here. It represented a $722 increase in their monthly obligations. They said, no way, can't do it. So here's the solution, right? This is what are we looking at from a solution? Stay in Northern California, which they were 100%. This is what we're going to have to do. They thought about squeezing the finances, making the move. They decided not to. They said, no way, I can't do it. Look at homes at lower price points. They did that. Okay, they looked at that with the agent. weren't really happy with the homes that they could get at a lower price point closer to the kids. They also, rent was out of the question in their mind. And they were looking at other areas near the kids. They found some homes too far away. And they decided, you know what, I think we're going to stay. They were talking to their agent. I think we're going to stay. So what happened? From another broker, another real estate agent basically said, hey, why don't you talk to, I use Shelley at All Options Mortgage. That was not the name of it, but for this purposes, that's the name of it. What did Shelley do? Introduce them to the reverse purchase, the HECM for Purchase program. That's one and the same. So how does that work? Everybody pay attention. This is how it works. It's pretty simple. Remember, it is nothing but a mortgage. The only thing that's different is how you pay back the mortgage, okay? So using the 400 of proceeds that we talked about, remember, they were going to use that for the traditional. Using the 400 of proceeds, they will they'll sell that getting from the proceeds they would from their departure home. They would bring that to the table, just like they were going to do before. The difference is we're going to cover the 250 with a HECM mortgage, a home equity conversion mortgage, which is another name for a reverse mortgage. So this is how the purchase works. You're not using equity. Most of you that have any idea what a reverse mortgage is, you probably think, oh yeah, that's when you own your home. And when you have equity in your home, you can take payments out of it. You can get a lump sum. You can get money from your home, which is true. For the purchase product, you're bringing the money to the table. Again, most of the time, that is usually from the sale of the departure home. But there have been times where people just use their assets and do it too. So in this case, with the Joneses, they brought $400,000 of the proceeds from the departure home. Remember, the price of the home in Phoenix was $650,000. So they did a reverse mortgage on that other $250,000 that was owed. What is their monthly mortgage payment? Look at this number, 0. Why? With a reverse mortgage, just like a traditional, with a reverse purchase mortgage, you do not have to make monthly mortgage payments. You can if you want to. And there are actually some retirement planning strategies with lines of credit where people will, very strategic way. Most people do not. So there's a 0 monthly outlay debt service. So remember, the property taxes, HOA, those are still the same, $621. So their total monthly payment in this example was $621. So think about it. They bought a $650,000 home. They brought $400,000 to the table of cash. That other $250,000, we did a reverse mortgage on that was owed. So they essentially bought that home with cash out of pocket for $400,000. Now they don't have a monthly mortgage payment for the rest of their life if they don't want to make it. Rob, how does that work? It's basically a loan where instead of making the monthly payments on a traditional, you don't make the monthly payment, so the interest gets added to the back end of the loan. And a lot of people will say, Rob, that's it. That's how you got it. It's not free. Okay? It's not a free loan. It is a mortgage. So it's just a strategic way that the boomers are finding, because most of them have said, hey, I've paid for the kids, or I have other assets where they're going to get for the inheritance. They're not going to live in this home. I don't want them to have the cost of selling a home to make the money off of the home and get hit pretty hard with the capital gains. There's all sorts of strategies. But a lot of the boomers, when presented this option, are opting for this. Problem is, no one knows about it. This is where you guys should really take the bull by the horns. Get back in touch with those fence sitters we talked about earlier that did not transact, that happened to be over the age of 62 years old. Get in touch with them, introduce it, work with your loan officer on coming up with a strategy on drip emails. If you happen to know a customer or 2 or 3 that happen to live locally and you had a good relationship with them, they just never transacted for whatever reason, probably because interest rates went up when they were looking, have them come to the office. Have the yourself and the loan officer, who the loan officers are the expert. You're not expected to be a reverse mortgage expert. That's why this is very high level, just understanding the high level portion of the reverse mortgage that will warrant you new business. It will. I'm going to go off on a little bit of a tangent. In a different life, I did a white paper, and we sent it to over 500. It was a survey that we sent over to 500 reverse purchase customers. Got about little over 150 responses from it. Okay. One of the questions on there was, would you have purchased this home if it weren't for the reverse purchase financing? 72%, I believe it was 71.8 or something like that percent, said they would not have. So what does that tell everyone? What it told me was, my gosh, why doesn't everyone that's a baby boomer know about it? No one knows about it. Agents don't know about it. Builders, customers, just like I said earlier on in the presentation, people don't know about it. So if I were you, I would just say, bring it up. Let people know there's an option. We're not trying, because I've had a lot of agents in the past say, Rob, you're just trying to get my cash buyers. No, I'm not. None of the LOs that you're working with are trying to do that. Cash buyers are going to still be cash buyers. Your traditional buyers are still going to be traditional buyers. This is going to get you buyers that you've never been able to capture before. Why? Because they didn't know about it. And they're a little worried about their finances, especially in an economy like this. We just saw today, the CPI numbers went up. Projections, it's going to continue to go up. So you want to talk about boomers that are on fixed incomes that are going to be more concerned about their expenses? This could mitigate a lot of that. This financing could mitigate a lot of that. Sell their departure home, keep a significant amount of their departure home proceeds in their retirement portfolio, buy the home they want, and not have to worry about the monthly mortgage payments. It's going to help. You guys just need to know enough high level just to bring it up. That's it. Okay. So with the other 50, remember they got 455. I just put 50 in here. What did they do with it? They basically, if I remember correctly, they used it for some upgrades and things like that. And they have $542 less in monthly payments than they had when they lived in Northern California. And they don't have to draw from their 750 nest egg anymore. So it was a win-win-win. Everyone was happy. This is a scenario that's a stereotypical scenario for you. This usually helps paint the picture if you didn't know what it is. We went through a conclusion. Yes.
You got a quick question. Just can you clarifying how they still have 750 in the bank? Didn't they use 400 to purchase a new home? There was
no, the 400 came from the proceeds of their departure home. Remember, they sold their departure home for $650. No, I'm sorry. They sold their departure home and they netted $455 from their departure home. Okay, so they sold it for $650. You remember correctly. Let me show you. They had $150,000 still on their mortgage. Where were we here? Here it is, right here. They still had $150,000 mortgage. Let's say this was their home in California. They sold it for $650, but they still had $150,000, and they netted $455 in proceeds. So that money that you used did not come from the $750, did not come from that. They kept that. What they were doing with that $750, if you remember correctly, they were drawing. I'm sorry, I'm jumping around, but I'm trying to explain this to you guys. They were drawing on this right here. Draw monthly on that asset of $750 to help pay with the living expenses. They didn't have to do that anymore. They used 400 of the 455, this number right here. They used 400 of that when they brought it to the table for this. There you go. There's your 400. Came from the departure homes, and they had I put 50, but it's really 55,000 left over roughly. And they used that for the expenses and getting things for the new home. Does that make sense? I hope that makes sense for everyone. It's very important to understand that. That's the reason and it's a good question, because it's important for you to understand the stereotypical way that you will see this used is the customers will usually use the departure home proceeds. They're going to keep as much of the liquidity in their retirement portfolio as they can, and they should. Makes sense. And I can't tell you how many times we end up talking to financial advisors, accountants, the people that are helping them with their retirement planning, that they have no idea how this works. Once you talk to them, they're blown away. I could go on a long diatribe of some of the presentations I've done on the purchase specific to financial planning associations across the country. They had no idea this exists, just like you guys. And they're blown away. And they're now starting to implement it where it's necessary to their clients, especially those looking to move. They're bringing this up. Okay. Conclusion. We know what the conclusion is, right? We talked about more cash, the kid's estate, but what about the kid's equity in the estate, right? Which I get this question all the time. I sort of talked about this a little bit. But what's happening is, less and less kids are, the baby boomers kids are looking to use that home as the only asset, less and less. Is that sometimes that is absolutely 100% what they're going to do. And if that is what they want to do, this loan is not good for that customer, period. If they're looking to give their home to the kids as the asset, and that's the bulk of their assets, probably not a good program for them if they're not going to make payments on it. Okay, it's not going to be for everyone, but it's going to open up buyers that you had no idea that you could get them to move. Because biggest reasons people do not move, baby boomers, as you can imagine, number one is outliving their finances. Number one reason. They're worried about it. Think about it. If they're not already on a fixed income, they're soon to be. And they got to start planning. Most people, unless you're highly affluent. That's number one. Number two, healthcare, which you can sort of correlate to both of them, right? Because that's part of planning for the future. Healthcare costs are going to go up. So anything that could help them move to a home, right size, downsize, whichever way they're looking at it, and still be able to hold on to a significant amount of money into their portfolio that could potentially grow, you're going to get a lot of people that feel much more comfortable, financially secure in that buying decision. Okay. I'm going to go real quick because I want to get this over and get questions. What is a reverse mortgage? I talked about this a little earlier. It is a mortgage. Homeowners keep the title, ownership. Lender holds a lien, just like a traditional mortgage. The way that it's paid off is different. That, in a nutshell, is what a reverse mortgage is. Okay. Right now, in today's world, with the rates, roughly 60 to 65% is how much they need to come to the table with a purchase. If the rates start going down, that means we can lend more money, which means the customer will bring less to the table. Okay. I'm not going to get into the refi aspects of it, but this is what we jumped into earlier, and I'll be really quick. Remember what I said. Lender takes the title of the home. You always hear bank owns your house. No, they don't. It's a mortgage. Borrowers need to own the home free and clear before they can get one. No, they don't. I just went through the case study with you. They had 150. As long as there's enough equity for that to make sense for them. Credit and income. There is a credit and income underwrite on this, by the way, which thank God that happened. And one of the reasons that the reverse mortgage used to get bad press, literally all you had to do was be 62 years old, live in the home as a primary residence, you got the loan. That's it, folks. Whether they were bad credit people or not their entire life, if that was the case, that's what happened. So real quick, ending it, HECM is not taxable income. So if someone wanted to make payments, they opened up a line of credit and they have $100,000 worth of a line of credit after 5, 10, 20 years, they could pull on that. The customers could pull on that and not get taxed, tax-free income. Remember, monthly mortgage payments are optional. The majority of customers don't pay them to help with their cash flow. It's going to increase their purchasing power. That is what you guys need to know. A customer that's coming to you, tell me if you've heard this. I have $400,000 in proceeds. I'm looking to buy cash, $400,000. I don't want a mortgage. 400. Everywhere you're looking, they want to move. There's no homes at 400. They start at 500. Introduce this. They could get a $500,000, $550,000, $600,000 home for $400,000 or less. They got a $500,000 home. They'd be bringing less than 400 to get a higher priced home. Underwriting criteria is less than it is with a traditional mortgage. I don't want to talk to you guys. You already know that the seniors with the home equity is just growing and growing. And that's it, folks. Sorry for the flub up earlier. questions.
That was great. I mean, honestly, I'm looking at the questions that we have, and lots of great questions for sure. We really want to make sure that you all know that Guaranteed Rate Affinity, really want to make sure that we are marketing more about this because we do realize that the demographics, especially for the boomers, it's exceptionally high. And this will be a product that will be starting to gain a lot of steam. It's been around, again, for a while now, but it's going to be taking a stronger hold in our market over the next 5-10 years. And what we really want to make sure is that we're educating as many of you as possible. Rob's point, financial advisors shockingly don't know about this, but when we educate them on it and they do their own research, they're blown away. It's a game changer, not only for them, but obviously for their clients that they're supporting and want to get the best kind of comfortable retirement as possible. So lots of great questions in here. I just want to start off with the one dispelling the myth about who has the house when, a borrower passes, or, what happens to the house. For so long, so many loan officers were telling people, the bank takes it, you get nothing. So we want to dispel, that's a big one. So we want to dispel that myth at the very least.
Sure, I can take this one, Rob. So, yeah, I mean, look, at the end of the day, the bank doesn't want to take the home. In fact, the bank, especially when there's money when there's still equity in the home, our goal is to make sure that the borrower or that the estate is accessing all that equity, whether they want to sell it, whether they want to refi or whatever. In fact, we've actually pushed a lot of foreclosures because we see the value in the home, and we want that. If we're like, hey, it's not selling, but we know that, or they haven't refied, let's help them, right? So, I mean, when the loan comes due and payable, the borrower gets a notification, says, hey, what do you want to do with the home? They say, you know what, want to keep it, want to get, we say, okay, get an appraisal. They still own the home, the estate still owns the home. They say, look, we want to refi, we want to sell it, we're not sure, but we need, some time. We'll give them up to 12 months to figure it out. And honestly, sometimes even more. We'll work with them actively. They have the ability, like I said, to sell it. They can always hand deed the lieu if they'd like, but it's up to them. It's their home, they're on title, the estate's property, all of it, and we're working with them to make sure they don't lose any equity in the process. The last thing we want to do is foreclose. But yeah, when that's done, when the borrower moves out or passes, we're reaching right out and saying, hey, estate, let's help you get access to, figure out how to, one, as a non-recourse, hey, you're not on the hook for anything that the home's not worth. But then two, the home's worth more than you're on the hook for. Let's figure out how to get that equity to you.
Yeah, it's lots of safety guards around HECM. Counseling gets involved, making sure that everyone knows exactly what the expectations are going to be. This is a very well thought out process. It is not, GRA. We're very accustomed to getting the contract and getting the closing in 10-15 days, and that's amazing. We do a great job of that. Reverse is a little bit of a different kind of an older school of approach. It does take a little bit longer to do a HECM purchase. And when I say longer, 30, 60 days probably is where it's going to be, because we want to make sure that those borrowers that are, having their questions answered, that their family gets their questions answered. So we feel very confident and comfortable with this. We just need to make sure that we're getting that education out. And by and large, you had probably a GRA loan officer that invited to this call, which is great. Please get back with them. If, lots of questions here, your GRA loan officer can help you out. We have reverse certified specialists all around the country that'll be able to really help dig out, those questions that you have, any apprehension that you have. But this is going to be, opportunity for all of us in this industry, real estate and lending, to really help generate this market, to keep it going, to keep it healthy, and obviously to really honor, our folks that have been around that have been in the mortgage space and buying their homes for, until they're 50, 60, 70 years old, 80 years old. Let's help them out, have a great retirement. And still, lots of people, lots of questions about, you're telling me that they're not going to have a mortgage payment. They're going to get into a house and not have a mortgage payment. And the answer is yes. And what Rob literally just ended with, it's the vast majority of borrowers that do this purchase with reverse mortgage do not have a mortgage payment. It's an exceptional product. So help us spread the word, get it out there. Rob and Francis, I really appreciate everything that you've done to really help educate not only our loan officers at GRA, but so many of our great referral partners from around the country. And we're going to keep doing this. And we're happy to keep these calls going. So everyone, thank you so much. Rob, Francis, again, thank you to you and your team for such a great partnership. And everyone else, we will see you on the next call. We'll have a call recording for you along with the deck and slides. Let's see if we can keep building this out. All right, everybody. Thanks again. Have a great day.
Bye-bye.